Welcome back to The Boring Accountant. This channel is all about taking the boring parts of money, tax, banking, investing and small business and turning them into simple practical steps, especially for Kiwis and small business owners. If that sounds useful, consider subscribing so you don't miss out on the next one. Today we're going to be talking about how the New Zealand income tax system actually works and the one thing that almost everyone gets wrong about the tax brackets. Now here's a quick question. If your income goes up and you tip into the higher tax bracket, do you pay that higher rate on everything you earn? Heaps of people think the answer here is yes. I've heard many business owners talk about turning away work to stay under a threshold. I've heard traders worry about a big year will wreck them at tax time, but the answer is no. And once you understand why, a lot of tax decisions get much simpler. The New Zealand income tax system works in slices. Your income gets divided into bands and each band has its own rate. Right now the first slice is up to $15,600 and is taxed at 10.5%. The next slice is up to $53,500 and is taxed at 17.5%. Then it's 30% up to $78,100. Then 33% up to $180,000. And 39% on anything above that number. So here's the key bit. If you earn $80,000, you do not pay 33% on all of that $80,000. You pay 33% on the bit above the $78,100. The rest of your income still gets taxed at the lower rates, so there is no cliff. A pay rise, a good season, a strong payout, extra income always leaves you better off after tax. Turning down income to dodge a tax bracket is like refusing a pay rise because you'd have to pay a bit more tax on the rise itself. It just never adds up. Now, how does the money actually get to the IRD? Well, it does depend on how you earn. If you're an employee, it's PAYE, pay as you earn. Your employer deducts tax from every pay, and for most wage earners, the IRD squares it up automatically at the end of the year. If you've got money in the bank, then your interest usually has RWT, resident withholding tax, taken out of it before you ever see it. But if you're self-employed, a sole trader, or in a partnership, or a contractor, nobody deducts anything. You get paid the full amount, and then the tax bill arrives later on. So that's where provisional tax comes in. Provisional tax is not an extra tax. It's the same as income tax, just paid in chunks during the year instead of one big hit at the end. Provisional tax kicks in once your tax bill passes the $5,000 threshold. And here's the trap for new business owners. In your first profitable year, you can end up paying last year's terminal tax and this year's provisional tax in the same 12-month period. So for many, that is a cash flow squeeze and catches people out. It's not the tax rate, it's just the timing of the payment. The last piece of the puzzle, your business structure, change how tax flows, not whether it exists. Sole traders and partnerships are really common in businesses in New Zealand. Now they don't pay tax as a business. The profit flows straight through to you as an individual and you pay the tax at your personal rate. Companies, they pay a flat 28% on income tax. And when the company pays you a dividend, it can attach imputation credits to that dividend, which is basically a receipt for the tax that they've already paid. So you are not taxed twice on the same dollar. Trusts generally pay 39% on income kept in the trust, but income paid out to the beneficiaries is usually taxed at their own rates. And here's the reality check. No structure makes tax vanish. They just change the timing and the rate. And the right setup depends on your income, family situation and your plans. You don't just copy your neighbour's structure. Get advice on yours. If you found this helpful, hit like so more people see it. And subscribe to The Boring Accountant for more simple, practical videos on money, tax, investing and small business in New Zealand. If you've got a question, drop it in the comments below. I might just turn it into the future video. Thanks for watching. And remember, tax works in slices, not cliffs. So never turn down a good year to dodge a bracket.